Good evening, everybody. Happy Thursday, April 22nd, and welcome to the special session with Senior Analyst and Agency Director Scott Forehand, talking about debt-free life and this important program and how we are changing people's lives for the better with this. I have done many cases. Scott has done many more cases. As a company, I think the numbers are getting a little bit wild as far as how much debt is being retired by the plans and how much it's improving our clients' retirements. So I don't want to give you outdated data, and I can't keep up with the current stuff. But Scott, want to turn it over to you, and I want to thank you very much for investing the time in everybody and sharing what you've learned along the way.
Right on.
And we have new information about the new program too with Symmetry, right?
Yeah, I'll let you know what I'm able to let you know.
Okay, cool.
All right.
Without any further ado, Scott Forehand.
Right on. Thank you very much, Tom Deutsch. Welcome, everybody. My name is Scott Forehand. I am direct to Janet and George Matthews here at Symmetry Financial Group. I'm an agency director here. And today we're going to be talking about debt-free life. Specifically, this is supposed to be just kind of a high-level overview of debt-free life, but I am going to go into some advanced strategy a little bit later on if we have enough time. Luckily today, the advanced market training is happening after this at 7 o'clock. Jamie McCrae is doing that on his own Zoom platform, so I don't actually have to. I'm able to go up to 7 o'clock and don't have to worry about being cut off and recording and all that other stuff. So we're not going to. So we can go a little bit longer today, depending on the questions that you folks have. A lot of you are very familiar to me. Some of you I don't know. So for those of you that I don't know or haven't seen before, welcome. For those of you that I know, good to see you again. So let's get rolling here. So I'm going to go ahead and start with the standard DFL presentation. And let me go ahead and get this set up and let's roll. Here we go. So debt-free life is it's a proprietary product from Symmetry Financial Group. It became available in 2019, May of 2019. And it is something that our company really feels strongly about. Debt is an evil thing, and it's something that's systemic within this country, and it keeps growing and growing and growing. And our goal, our job, our focus as a company is to make an impact, positive impact on the world. And this is one of the vehicles that we're using to do it. So if you are here for the first time, welcome. If you are here as a new agent, just learning taking some time to learn some stuff, fantastic. Welcome to the party. At the end of this conversation, if you're looking to potentially do one of these debt-free life programs for yourself, please get with whoever invited you here. And if they're a Symmetry agent, they'll certainly be able to direct you down this path and help you get set up with one of these programs. So without further ado, debt-free life. So debt-free life is actually a play on words. The design of these programs is using a life insurance vehicle and all of the IRS, how do you put this, benefits to our advantage, and using them to eliminate debt, actually using debt and debt service and changing the paradigm and turning it on its head and making the debt work for us instead of work against us. And in the process of doing that, we're going to be creating what's called a private bank using a financial concept called infinite banking. And then we're going to couple that with a debt elimination tool called debt snowballing, not debt stacking, but debt snowballing, or in some cases, debt avalanching. And we'll get to that in just a minute. So these are the two standard questions that we asked everybody. Are you 100% sure that you are going to have a great retirement? Do you have some doubt? Of course, everybody has doubt. Nobody is 100% certain that they're going to have a fantastic retirement, except for maybe some financial advisors or financial planners. And even then, I think even in the back of their mind, there's always a little demon saying otherwise. And if we could show you how to get out of debt in 9 years or less, including your mortgage, without spending any more money than you are today, would you be interested in listening to us? And of course, the answer is yes. Anybody who wouldn't answer that question yes is foolish, and they're probably lying. So moving on, where most Americans are these days, this is the typical American dollar that you have. 74 cents out of every dollar is spent on taxes and interest. And this certainly was not the intention of our founding fathers when they started this country. As a matter of fact, obviously, we all know the story of the Boston Tea Party. It was our country was founded in direct opposition to tax. And unfortunately, we've let the country's let it get away from us. And we've given the politicians probably way too much power, and they keep taxing and taxing and taxing. And it's unfortunate, but we do have some recourse. And a debt-free life program is one of those recourses. We're going to get you out of that place where you're spending roughly 1/3 of every dollar you make on tax. We're going to, or 1/4, 40%. We're going to get you out of that place where you're spending 1/3 of your money on interest. We're going to get you to a point where 1/4 of your money right now is all you have to live on. We're going to change that. And more importantly, we're going to get you to the point where you've got a really strong financial outlook as far as retirement is concerned. How are we going to do that? Well, let's talk about this for a second. I forgot the slide order. Sorry, guys. The average person in this country makes about $2 million in their lifetime. That's a lot of money. It's certainly enough money to retire on if you spend the money correctly. And unfortunately, we are taught from a very early age that debt is okay. And we're able to take on debt and then take on more debt and more debt. And as we earn more money, we take on more debt. Ultimately, the debt service is what defeats our retirement in the end. And unfortunately, with the standard of a 3% savings of your annual income, that leaves you with roughly $60,000. The average American only has $60,000 at the time of retirement. And if you're used to making $75, $100, $200,000 a year, $60,000 does not last long. And if you think for a second that $60,000 plus your Social Security is going to give you a secure retirement, you really are fooling yourself. So how do we fix it? Well, welcome to Debt-Free Life. When you have debts and you think that you have a problem, you're probably way beyond the point where you actually have a problem. And when you're talking to someone who's considered to be an expert in debt elimination, you're talking about someone who does debt consolidation, somebody who does debt counseling, those kinds of things. They purport themselves to be experts. And one of those 6 bullets to the right, or one or more of those, are what they're going to suggest and how they're going to structure your program to get you out of debt. And I'm going to tell you that every single one of those, with the exception of a true debt snowball, every single one of those is not tenable for a long term. Can you spend less money? Well, if you're just making ends meet right now, no, you can't. Can you save more? Absolutely not. If you're spending what you make, no, you cannot. Can you refinance your way out of debt? That's maybe, probably not. Can you consolidate your debt? That's not doing anything except for taking a bunch of little pots of debt and making it one big, large pot of debt. That really doesn't do anything for you. Can you work harder, go get a second job, go become a Walmart greeter on the weekend, go flip burgers somewhere? Yeah, you can do that. Is it going to be fun? Absolutely not. And is it tenable for a long term? No, it's not. Debt snowballing down there is the only one that we would say from a traditional aspect of debt elimination is going to work consistently. The problem with it is that most people don't practice true debt snowballing, because in order to do a true debt snowball, you have to have some discipline. And we'll talk about that in a few minutes. But so from a debt management, debt consolidation, debt elimination, debt counseling perspective, those are the 6 things that you're going to be told to go do. 5 of them are not going to work. So where are you going to be 5 years down the road? You will have paid them the money to get out of debt, and you're still going to be in debt. They got paid, but you're still where you were before. So there's a better way. So this comes down to that 9 years or less deal. And when I run these programs, and there's a number of people on here like Misty Hutt and some other people that have run a lot of these, we are not seeing this just a 9 years or less. We're seeing 15 to 27 years early is the reality. So most people's programs do come in at 9 years or less, but sometimes it's just not possible. So for example, if the only debt you have is a mortgage and you're just barely making your mortgage payments, this program is not going to get you out of your mortgage, out of your 30-year mortgage in 9 years. It'll do it in 15, but it's not going to do it in 9. So really, it's safer to say that we're going to be eliminating your debts 15 to 27 years early is what I look at. So how are we going to do that? We're going to get you from the left side of your screen to the right side of your screen. We're going to make it so that you're going to have, instead of spending 40 cents of every dollar on taxes, you're going to be spending 30 cents of every dollar. Let's put that in perspective. It's a 10% reduction, right? Nope. It's a 25% reduction in taxes that you're going to pay. And this is over the course of the rest of your life. It's not going to happen immediately. That interest rate, we're going to drop the amount of interest you're paying from 34 cents down to 23 cents, 23%. It's huge. We're going to change your lifestyle. What does that mean? That's the money that you live on. That's what you put groceries in your house with. That's what you pay your power bill, your gas bill, your light bill, your car payments, put gas in the car. That's your lifestyle money. Whatever's left over, you pay your Netflix or your Hulu bill. But what we're going to do is we're going to change that. We're going to go from 23 cents of every dollar, which is where you are right now, to 33 cents of every dollar. And that's a 10%, if you look number to number, that's a 10% increase? Not really. That's a 43% increase in lifestyle money. So let's put that in perspective. So let's say that at the end of the month, you have $1,000 left over at the end of every month. What we're talking about doing here is putting you in a situation where instead of having just $1,000, now you have $1,430 every month left over. We're significantly increasing your cash flow. And that's a critical part of this program. If it's tight, if it's uncomfortable, if it's, I got to go out and eat ramen and tuna fish for the next 2 weeks, you're not going to stick with the program for very long. If the program is, okay, now I've got extra cash, I see it working. I see it working almost immediately. Okay, now you're going to stick with the program and you're going to really dig in, and hopefully you're going to have that discipline. And here's the last part, that savings, moving from 3% to 15%, 12% increase, right? No, that's a 500% increase in the amount of money you have available for retirement. It's a heck of a lot easier to retire with $300,000 in the bank earning interest than it is to retire with 60. And if you are under 75 years old, these programs will still work for you. If you're over 75 years old, there's ways we can structure these programs, but unfortunately, we're not going to be able to use your life as the target of the program. You have to use a family member. So let's move on. So what we're going to do is we're going to reduce the amount of interest. We just talked about that. Eliminate your debt in 9 years or less, 15 to 27 years early, reduce the amount of taxes, improve cash flow, and allow you to retire with a tax-favored income. So if anybody out there, does anybody think that the best type of tax-favored income would be an income where there's zero tax? Welcome to the party. We'll get to that in a minute. So the thing that we're talking about is infinite banking coupled with debt snowballing. Infinite banking by itself is not a new concept. It's been around for a long time, for 100 years or more. And the concept of debt snowballing, again, around for a long time. But where most programs in the past have tried to marry these two concepts, these two financial concepts, they've all failed for some reason or another. Every one of them fails. Every one of them has an Achilles heel. And the most common reason why they fail is because they don't plan for the emergency. And I don't mean an emergency like you got to go take your mom to a hospital emergency. I mean, someone passes too soon, someone becomes unable to work, earn a living, pay premiums, those kinds of emergencies, real emergencies. So the program that we use, we've taken that into consideration, and the emergency is the number one cause of failure for all those other programs. So one of the first things we did when this program was created was put this program into a situation where that one primary cause of failure for all the other programs, we've eliminated it on day one. So what we've done is in our program, we create an emergency fund, and it's there and it grows, and you have access to it whenever you need it, but it's not easy to get to. So we want you to have it. We want you to be able to use it if you have a real emergency, not I need a new jet ski emergency or I need to buy a new plane emergency, but I've got a real emergency. We want you to be able to get to it, but we don't want to make it easy. So moving on. So when we look at different types of programs and how they might work, a tax-free solution, which is what we're looking at right now, debt-free life is a tax-free retirement solution. It is the most, from my perspective, the most beneficial type of tax-advantaged retirement because there is no tax. Because I've paid all the tax I'm ever going to have to pay upfront. Okay, this is better than a Roth because my Roth, my traditional Roth IRA, I'm going to have some limitations on when I can access that money, when I have to access that money, and certainly when I get to the point where I'm going to be potentially taking some gain out of it, there may be a taxable event. So Roths are good. A tax-deferred vehicle like a 401k, traditional 401k, they're fine. But everybody that took out a 401k, you're all starting to feel and starting to realize the lie that was told to you about 401s. The whole idea of, no, don't pay the tax now, because later on you can take the money out, and when you pay the tax then, you're going to be at a lower tax bracket. That might be true. You might be at a lower tax bracket, but I would bet you are not going to be at a lower tax rate. Has anybody looked at where the debt load for the country is right now? 27 trillion. Has anybody heard that Social Security is going to be bankrupt in 2030 unless they fix it? Did they just spend another couple $1 trillion to try to rescue us from this COVID nonsense, this COVID mess, right? All those things are happening, and they're all going to conspire, and it's going to be an avalanche, and it's going to be, unfortunately, a perfect storm of debt that this country is going to have to deal with. And the only way we're going to be able to deal with it, taxes are going up. How much? The last plan I saw said taxes were going to go up 1% per year every year for 10 years. That's federal taxes, people. That's across the board, whatever your income level is. So if you think for a second that you're going to be at a lower tax rate when you take your money out of your 401k, unfortunately, you've been sold a piece of the Brooklyn Bridge, and it's probably not going to be that way. So how do you get around that? Well, you bite the bullet now. You pay income tax now when it's a lower tax rate. And then you take the money out whenever you want to take it out. You do not have to subject yourself to IRS regulations as far as penalties for taking it too soon, guaranteed mandatory distributions and penalties for taking it too late, additional taxes, take out too much, pay a penalty, don't take out enough, pay a penalty. No, all that's gone. With this, you take the money when you want it, when you need it. It's your money. You are the bank. That's what this is. It's creating a private bank. Okay. And so when you look at a tax-deferred IRA, 401, tax-free, debt-free life, there is no comparison. Absolutely no comparison. And using the same numbers, the same investment as this graph shows you, same number of years of growth, same interest rate of growth, same taxable rate, by hands down, a tax exempt program is going to come out in way ahead. All right. Like all financial instruments, they work in phases. And the phase is determined by where you are in your life with respect to retirement and debt. So if you are currently under 75 years old and you have debt, great. We can use that. We can use that to fund your debt snowball. We can use that to grow your cash within your program. And then we can make it work for you. This is about changing the way you think about money, changing the way you spend money, putting you in a situation where you're spending it more efficiently and where you're making your money work for you. We've all heard that stuff before, invest in the stock market, make your money work for you, right? Well, this is that, except we don't care how the stock market goes, up, down, or sideways, we're still making money. We don't care, okay? So in this scenario, we're gonna put your money to work for you, and we're gonna use it over and over and over again. We're gonna recycle it. Then we're gonna get out of debt, and then we're going to reach the accumulation phase. That's all that is, hey, I'm saving for the future. I'm making my money work for me and growing my money over and over and over again. And then finally, the distribution phase. That's when you can go out and buy that emergency jet ski anytime you want with your money. And you can go buy that new plane, and you can go buy that new whatever, sports car, whatever you want to do. It's your money. You do what you need, do what you want. So I mentioned that this is not a new concept. Infinite banking has been around for 100 plus years. And the people that are on that screen right there, there's my attack Chihuahua Chico. the people that are on that screen right there, these are people that have done this before. Walt Disney did this when he funded Walt Disney World down in Florida. This is how he did it. Doris Christopher did it when she started her program. Ray Kroc did this with the first 12 McDonald's locations that he opened. Warren Buffett still does it to this day. It's a standard method in one of his financial tools that he uses to fund his empire, right? This is not new. It's been around for a long time and it works. The difference is, if you see something with those 4 people on the screen, you should see something in common with all those people. They're all very wealthy. In order to do these programs in the past, you had to be very wealthy. And now you don't have to, because we figured out, meaning Symmetry, Quility, has this program where we've enlisted the services of three of the largest insurance companies in the world to be able to create this very specific program with a very specific set of riders to be able to accomplish what we're trying to do. So moving on, we're going to redirect your inefficiently spent dollars. That's what I said a few minutes ago. So we're going to allow the cash value to grow. We'll talk about that in a minute. Pay off all your debts, repay your loans, there you go. That's a big one. Repay loans into policy with freed up cash flow. What does that mean? That means if you structure these correctly, just through the normal practice of paying your premium, your loans get paid off automatically. And sometimes when you stop paying your premium because you can, the loans will get paid off automatically by themselves. The program can actually pay the loan off for you. Think about that for a minute. I'm going to borrow some money. I don't have to pay it back. Yep. How? Stay tuned. All right. Leave a legacy. This is really cool. So one of the things, if you look back in history, how the Rockefellers managed their money and how the Rothschilds managed their money, they used programs just like this. Because if you structure it correctly, remember this is life insurance, structure it correctly, you can move money from one program to another, and you can have that money be generationally transferred. I don't mean me taking out and putting money into an account for my daughter. I mean, I can do a program like this and start something for my great grandchild. I can skip 2-3 generations and make that money live forever and make my family be financially set forever if you do it right. That's one of the true digging in deep, really understanding how the programs can work. That's an amazing feature of this program. So these are some old photos of people that we did in the first year of doing this. All this is the same. We've already talked about all this, 9 years or less, 15 to 27 years early. Interest paid to lenders gone, cash flow, taxes, all that stuff is right. How does it work? Well, first we have to look at how you spend money. All right. So Misty Hutton, you make some money. That money gets deposited into your checking account as income, goes into your bank, your Wells Fargo, your Citibank, whatever. Doesn't matter who it is. Doesn't matter who you bank. And then that bank is very thankful that you've decided to use them as your bank. And they've decided that they're not going to charge you for you to keep your money in their bank. And what they're going to do is they're going to lend that money out after you've moved your money into their bank. They're going to lend that money out every night to the other banks because there's a law. They have to keep a certain amount of money on their books to make sure that the bank is solvent. Okay? They're going to make money with your money every night, anywhere from the federal funds rate, 0.24% right now, all the way up to 24%, depending on how long the lends it out and how much. And they're going to give you zero. They might give you a thank you, probably not. Probably the only thing you're going to get from them is going to be yeah, we'll let you put your money in here. We're not going to charge you the $25 fee, but we're going to charge you $5 for an overdraft protection and $10 for this and $6 for a paper copy of your ledger and $4 for a new debit card, whatever. They'll find ways to charge you money. That's how they do. Banks don't own anything. The only reason banks have any power is because we gave it to them, right? So at the end of the day, you still have debts. So you're going to tell your bank, because you wrote a check or because you went into your bill pay system and typed it in, hey, I want to pay my car payment. So you tell your bank to pay your car payment. What do? Tell the bank to pay your debt. And then all of a sudden, the money comes out of your account and it goes to your creditor, and it pays your car payment for you. And what have you done? In the end, you spent whatever your car, $500 is your car payment. You spent $500. You deposited the money when you made your money as from your check, your W-2, 1099, whatever, into your checking account. It sat there for 7 days or more. The average dollar you put in to your bank is spent and lent 7 times by the bank before you actually get to use it. Okay. So they're going to make money with your money 7 times, and then you're going to pay your debt, and then your money is gone forever. And you have moved your money from the left side of the screen, stopped off at the middle, and moved to the right side of the screen, and your money is now their money. And if you're super sweet and super nice and ask that creditor really, really, really nicely, can I have my money back? You're going to get laughed at, and the answer is going to be no. So there's a better way. Here's the better way. This is the debt-free life method. So what we do here, nothing changes about how you make money. You still make money, you still go earn it, whatever. You still have income. You still deposit that money into your checking account. But this is where the rubber meets the road with this process. This is where we change lanes, okay? So I'm going to say, wait a minute, Mr. Bank. I don't want you to hold my money for 7 days and lend it out day after day after day. I need to make my life insurance premium payment. So you do. And what is it? It's a whole life. So that's what the DFL program is built on. That's why our program works where the other programs fail. That's why our program has protections in place where the other programs, like you used an indexed universal life, or you used a HELOC, home equity line of credit, as your banking instrument. All those programs fail for a reason, lots of different reasons. Our program, we've fixed that. We are basing our program off of a whole life policy, but it's special. It's a special kind of whole life. It's called a participating whole life, which means you are able, as an owner of that whole life policy, you are able to participate with the profitability of the company, the carrier, that offers you the life insurance contract. Does anybody ever heard of a bank that has failed? I think you can probably all name a half a dozen of them pretty easily. Does anybody know of any brokerages that has failed? Stock brokerages, Lehman Brothers, Bear Stearns, right? There's tons of them, right? Does anybody know any insurance companies that have failed? You know why? Because insurance companies are the most profitable companies, profitable businesses on the planet. Specifically, they've created more millionaires than insurance agencies, financial agencies. They've created more millionaires than any other industry in the history of the world. And there's a reason why, because they make money. So what we just said is a participating whole life allows you to participate with the profit of the company that offers you your contract. Now, look, we're adults here, right? They're not going to give you all of their profit. They're going to give you access to some of it. So the companies that we use, there's 3 of them, the companies we use give you a guarantee of 4% on your money. So let's compare that to a savings account with Bank of America. Bank of America pays 0.25%. This company pays 4%. That means you're getting 16 times the return on your money with a life insurance policy that, oh wait, it's also tax exempt because it's a life insurance policy. Okay, so I'm going to get 4% and I'm going to get a dividend. But wait, it gets better. How? Well, because along with that whole life policy, that participating whole life policy, I'm also going to take out a term rider. Okay, why? So this gets down to the minutia of IRS tax code 7702A, which is why we're able to operate this program and have a tax exempt retirement. And that's specifically because tax code 7702A says 2 things. Number 1, monies derived from a life insurance policy are tax exempt. That's universal. We all know that. Everybody knows that about life insurance. If someone gets paid a death benefit or gets paid money from a life insurance program, it's tax exempt. Everybody knows that. The other part of this says, and they understand that there's a way that you can manipulate the numbers. If the cash value, because remember whole life builds cash value, right? If the cash value exceeds the life insurance value, then the program becomes what's called a modified endowment contract, a MEC. And what that means is the game's over. Everything just became taxable. Even though you may have already paid tax on the money that you put into this, when you pull the money out, it's taxable again. Welcome to double tax, okay? So we do not want this to become a MEC. The way that we avoid that is by having that term life rider. Why? Because term life is cheap and because you get a lot of coverage with it. So if I have this little tiny whole life policy, let's say it's a $50,000 policy, but I had this massive $700,000 term life rider that costs $20 a month, right? What did I just do? I created enough room so I can grow $750,000 of cash in my program without ever having the IRS be able to say, hey, that's a MEC, I want tax, right? This term life rider acts like an umbrella that the IRS cannot see through. And all they do is, how much is the life insurance value? $750,000. How much is the cash value? $400,000. Okay, not a MEC, carry on. And that's how this works. But wait, it gets better. How? That's because when the money hits the carrier, it gets split into three parts. The first part is whole life. That's the core policy. That's the whole life policy. Remember, whole life policy, term life rider, paid up edition rider. Okay, so the paid up edition rider and the term life policies are not additional life insurance. They are part of the core policy. So you're only making one premium payment, right? It's just when the money hits the carrier, it gets split. How it gets split is dependent upon your goals. Everybody's policy and program is unique. It depends on what your goals are, what your debt load is, what your debt service is, when your retirement age is coming, how much you want for retirement, all those things. So you're going to need to get with your professional DFL agent to be able to determine how to use it. But in general, what we look at is about 10, 11% of your premium goes to pay for that term life rider. 20 to 22% goes to pay for that whole life core policy. And the balance, roughly 70%, 65 to 70%, is what goes to buy paid up additions. Let me come back to that in a second, because I want to go back to the whole life. Remember how I told you earlier on, there's an emergency fund. This is where the emergency fund lives. There's a cash value that you build every month when you make a premium payment in the whole life core policy. There's a cash value. Cash value you don't see. It's there, you don't see it. And it's roughly based on half of whatever your whole life portion is. So if I'm paying 20% of my $100 a month payment, if I'm using 20% going to whole life, half of that's going to cash. So I've got $100 going to the carrier, $10 is going to pay for my term rider, $20 is going to my whole life. Of that $20, $10 is cash value, $10 is the cost for the whole life insurance. And then 70% is going to paid up additions, right? So that $10 cash is going to my whole life cash value. That's building my emergency fund. The paid up addition, 70%, guess what that is? That is additional life insurance. It's a paid up addition life insurance. So in a banking term, what that's called a tier one asset, tier, T-I-E-R, one asset. It's called a tier one asset because it has guaranteed value and low cost of maintenance. How much does it cost to me in a 1,000? So if I buy $1,000 of paid up life insurance today, it's paid up. I don't have to pay any more to maintain it. It's worth $1,000. Tomorrow, it's worth $1,000. 10 years from now, assuming I'm still alive, it's worth $1,000. And when I die, it pays $1,000 to whomever the beneficiary is. That's why Wells Fargo, for example, 48% of their assets are structured as tier one assets, life insurance. That's why there are companies out there that go around and buy up life insurance policies, and they'll pay pennies on the dollar because they know that's a sure bet. Because insurance companies don't go out of business, okay? Because insurance companies co-insure each other. Because if insurance company A has a really bad year and they actually do die on the vine, insurance company B is going to buy their book of business and service it. It's secure. It's as safe or safer than any bank that's out there. And the banks know that. That's why they buy so much life insurance to have on their books as an investment. So if 70% of every payment that you make is going to buy paid up additions, what's that doing? That's increasing every time you make a payment, the amount of life insurance coverage you have. That's the first thing. But here's the cool thing. Because of the way we've structured these, because of the arrangements we've developed with these three carriers, the carrier is going to pay you, remember I said 4% guaranteed return, right? They're going to pay you 4%, not just on the cash value that's hidden in the whole life. They're going to pay you 4% on the paid up addition. They're going to consider the paid up addition as cash. Because in the end of the day, what is it? It is cash. They're using it, they're investing it, they're hedging with it, they're making money with it. Don't worry about the insurance carrier. They're paying you 4% guaranteed, which means they're making at least 16 or 18 on it. Okay. So, but here's the kicker. So not only are you earning 4% on the whole life cash value, you're earning 4% on the paid up addition value. 70% of every premium payment buys more paid up addition. Okay. And then here's the kicker. These three companies, these are all mutual products. In order for them to maintain their mutual status, they have to pay a dividend, and they do. So the dividend, all three of these carriers have paid a dividend every year they've ever been in business. And I have a favorite carrier for reasons we're not going to discuss here, but the carrier that I like has been in business for over 100 years. And some of their first clients had the last name Rockefeller and Rothschild. Okay. So there are midterm players who've been doing it for 40, 50 years, and there's new players who've been doing it 20, 30 years. The bottom line is they all do it kind of the same way, but they all pay a guaranteed interest rate plus a dividend, which when you couple those two, here's the cool thing. When you couple those two, that means that you're getting a pretty strong interest rate. So just to put things in perspective, the smallest dividend that I've seen over the last of record is 0.25%. Okay. The largest one I've seen, which is about 22 years ago, was 11.9, I think, 11.9%. That's a dividend. Okay. So if you average it out, 17 out of 20 years, the dividend plus the guaranteed interest rate is going to be larger than, and here's the kicker, how do you get money out of the program? Oh, yeah. Let me finish this part. I got ahead of myself. Sorry. So earlier in the previous example, the bank was making money with your money over and over and over again. So what we're doing is we're moving that circle of replication of dollars, the dollar cycling, we're moving it to your bank so that you get to make money with your money over and over and over again. Okay. And remember, you're making 4% plus a dividend. We'll get back to that in just a second. But what happens when you have to take money and go pay your car payment? In the previous example, as soon as you took the money out of your bank, the bank sent it to your debtor, your creditor, and paid your whatever it was. And then the money was gone forever. Here, we're going to do it a little bit differently. Here's how the system works. We actually take a loan, okay? This is why I got a little bit too far. So we take a carrier loan. We take a loan from the carrier. These programs are structured to do this exact same thing. I'm able to put money in and borrow money out. Money in, my money goes in, borrow the money, pay the debt. And then I tell my checking account company, Wells Fargo, Bank of America, Citibank, whoever you have your checking account with, whoever you bank with, I tell them to pay that debt. And then they pay the debt. And then the creditor's happy because they received the money. They don't care where the money came from. They just want their money, right? Where's my money, Misty Hutton? Where's my money? Yeah, go ahead.
See your money's still in your bank.
Yeah, right on, girl. My money is still sitting in my bank, which is my debt-free life bank. I did not use my money to pay that debt. I used somebody else's money. And when you talk to the wealthiest people in the world, this is a concept they will all tell you. Whenever you have an opportunity to keep your money and keep your money working for you and use somebody else's money to pay off your debt, that's the best way to do it. That's how the rich stay rich and the rich get richer, because you're using other people's money to pay their debts. So welcome to a program that was only available to the wealthiest segment of our population for the last 100 years. That's what this is. So let me get back to this. There's a concept I want to make sure we drive home called arbitrage. So if you go to a bank and you with $10,000 and you deposit it and you get a certificate of deposit, a CD, they're going to give you an interest rate on your money. And they're going to say, thank you very much. We'll keep your money for a year. You can come back in a year. We'll give you all your money back plus interest. Fantastic, right? The interest rate they're going to pay is around 2%. And let's say the very next day your car dies and you have to go out and buy a new car. And you go back to that bank and you say, you know what? I need to borrow money. I need to go buy a new car. The car is going to cost me $10,000. Can I have my CD back? Well, yeah, you can, but you can have penalties. There's going to be penalties. Okay. But tell you that we'll use the CD as collateral and you can borrow the money. Okay, great. How much is it going to charge me? 4%. So what did the bank just do? The bank borrowed money, which is your CD that they're paying you 2% on, and they lent you your money at 4%, and they're capturing the delta of 2%. They used your money to lend you money. And in the process of doing that, they created positive arbitrage for themselves. It's the same way credit cards do it. So when you take out money on a credit card, let's say you got a standard high interest rate credit card, 22, 24%, they're borrowing the money at 8%, lending it to you, making the difference. That's how they make money, okay? So we're changing the game. We're changing the paradigm. So instead of allowing the bank to keep my money and charge me more money to use my money against me, I'm going to put my money into my DFL bank and I'm going to get 4% plus a dividend. And I'm going to borrow my money, depending on the rate at the time, 4.67%, I think is the current rate right now. So I'm going to borrow money at 4.69%. I'm earning 4% on my money. That means what did I just do? I created an opportunity for me to borrow money at the worst case scenario of 0.69%. Worst case. Aha. But what about the dividend? Well, the dividend comes in too. Comes in at the end of the year. The dividend, 17 out of 20 years, the combination of the guaranteed interest rate plus the dividend is going to be greater than 4.69%. It's going to be greater than what your interest rate is that you're borrowing against, which means at the end of 17 out of 20 years, you're going to have more money in there than you started with, and you're still going to have spent the money. And you use their money. And you can do it over and over and over and over again. That's what we call dollar cycling. I'm using the same dollar. I put the money in, I leave it in there forever. I take a loan out, pay off my debt. What do I have? I've got less debt. If it's a house, what do I have? I've got more equity in my house. If it's an annuity, what do I have? I have another income stream. So there's lots of ways you can use this program. Okay. So how does it work in real life? Okay, so here's a family I worked with last 2 years ago, I think. Halloween 2 years ago. Okay, so this family has a lot of debt. They were a mixed family. Both had been married previously. They both came to this with residences. The wife was a doctoral student at that time. She's now got her PhD. She has a tremendous amount of student debt, about $110,000. The husband is a truck driver. Owns his own rig, but has a lot of back taxes that he owes. So they had a pretty heavy debt load that they were dealing with. So when we looked at their debt service, they actually owed $584,000. That's not their true debt. That's how much they owed if they were going to be able to pay all of their debt at one time. Because they didn't have the ability to write a check for $585,000, they had to finance the debt. Student loans are evil, everybody. Student loans are evil. So the way they financed the debt is they borrowed the money, right? And they had, after you looked at what the track they were currently on, they were going to actually pay $767,000. That's $182,000 in interest. That's a ton of interest. So our program got them out of debt in 7.8 years. They are now 2 years into this program and loving it, by the way. Okay. And they are now down here. They've gone all the way through all this stuff, and they actually just paid off that car. They paid off a $39,000 car last month, actually. And these folks are executing the program exactly as we roadmapped it out for them. Okay, 7.8 years. So they went from 40 years of planned debt, where at the end they would have 100% equity in 2 homes and 0 extra. This is key. 0 extra. So what we did for them is instead of paying the debt for 40 years, we got them out of debt in 7.8 years. That's pretty strong. It's actually better than that. This software has some limitations that we use, and I'm not able to demonstrate some of the advanced payment techniques that we use, like like mortgage chunking. We'll just leave it there. So let's look at this. This is their roadmap. They had $182,000 of interest scheduled, 40 years to get out of debt. We moved it from 40 years to get out of debt to 7.8 years. We saved them $70,000 in interest. I don't know about anybody out there, but if I'm walking down the road and I see $70,558 laying on the side of the road, I'm going to pick it up. It's going in my pocket. And if anybody sees me, I'm going to say, is this yours? And they say, no, it's still going in my pocket. Okay. That money just became a nest egg for, my wife, my daughter, my family, whatever. But look at the bottom of this. This is where the rubber really meets the road. 40 years, 182,000 of scheduled interest. You can have that, or you can get out of debt in 7.8 years, save $70,000 in interest, and in that same 40 years, have $4.8 million liquid cash in your program. I did this with a horse farmer a couple of years ago. He was in a similar situation to this, and we actually got him out of debt about 3.5 years and increased his retirement program from where he was at, which is just over 4 million when he turned 65, to having 41 million at age 60 using the same program. Okay. More importantly, check this out. $5.9 million combined in cash and death benefit. That means he had a $1.1 million life insurance policy fully paid up at the end. Now here's where you're getting ready to have an aha moment, Misty Hutton. Misty, I keep going to you because you're the only person who's live on my screen and you're the first person down. So that everybody else is just static pictures. So sorry, I'm picking on you. I don't mean to. All right, so here we go. So in the first year, we're paying off a ton of debt. Really pay attention to this, folks. In the first year, we paid off $14,915 worth of debt. At the end of that first year, not only do we pay off $14,915, we also have $12,225 left over in our bank. That's pretty strong. Now, remember the debt snowball? This is where the debt snowball kicks in. Now I'm dumping in money left and right because those debts that we had before are now paid off. In the first year, they paid off 9 of these debts. In the first year where they started their premium at, they're now adding an additional $1,030. This is zero cost to them, people. This $1,030 that we've grown, this roll-up deposit amount, that $1,030 is derived because that was the minimum payment on those 9 debts. They're still paying the debt. It's just now they're paying themselves back because they borrowed money from themselves to pay the debt. So now they're paying the money into their program. They're using their traditional standard payment, and now they're adding in $1,000 a month. And that $1,000 a month, remember, we talked earlier, one payment, 20% goes to whole life, 10% goes to term, 70% goes to PUA. Well, that $1,000 is 100% going to PUA. That means that $1,000, 100% of it's getting applied to 4% interest rate, 100% of it's getting applied to dividend. Month after month after month, okay? This is a juggernaut. And for this particular family, it is doing exactly what we illustrated. It is a juggernaut now because they're following the program. Okay, so how does it work? Every one of these years, we see a yellow row. That's a year where we pay off some debt. And this year, we paid off $14,900 of debt, had $12,000 left over. Remember, we just showed you, we paid off 9 debts in the first year. The debt snowball is massive at that point, $1,000 a month extra. They're doing $12,000 a year extra into their program, plus they're earning 4%, plus they're earning a dividend on top of that. Boom. They're paying off $15,000 of the debt in their second year, and they still have $40,000 left over at the end of the year. The next year, they pay off $58,000, and they still have $30,000 left over in the program. But here's where the danger happens. See that? 7486, loan from savings. There's the speed limit. Remember I told you the IRS, there's a maximum amount of cash you can put into these programs. In this particular instance in year 3, which is happening right now, they had to put $7,486 into a savings account, earning only 2%. And the reason why they had to do that was because if they tried to put any more money into their program, the cash value would have exceeded the MEC number, and they would have MEC'd out, and they would have been everything would have become taxed. So that's the danger. So, but we know we structure these programs, we protect against that. Now look at this, year 4, we've paid off every debt that they have by the beginning of the 4th year. Every debt's gone with the exception of the 2 houses and the $110,000 of student loans. Student loans are evil, people. So $110,000 of student loans. Wow. Okay. So in this scenario, at the end of the year, we have $91,000 in our bank, in our private bank. But it's not enough to pay off one of those homes, which is $96,000. So we had to go a little bit into the 5th year before we had enough money in our account to pull the trigger, pay off that loan. We paid off a 27-year mortgage in 4 years, 4 years and 3 months. This is going to be happening sometime in probably early first quarter next year. The very next year, boom, pull the trigger again, pay off the second mortgage. Actually paid off the student loan. And then in year 7.8, pulling the trigger, paying their balance on their primary residence. So they paid off 2 houses, $110,000 of student loans, another $80,000 of car loans, and another $50,000 of back taxes and credit cards. They did all that without having to go make more money, without having to go eat tuna fish and ramen, without having to consolidate debt, without having to go take a home equity line of credit, without having to do any of those things a traditional debt consolidation group is going to tell you to do, simply by doing it with a life insurance policy and using the IRS protections that are afforded to us under tax code 7702A. A couple other things I want you guys to notice on this. So in this scenario, their growth is phenomenal. I'm growing $100,000 a year, but I'm only paying in $32,000. I'm getting $68,000 a year growth just from interest and dividend. And then I'm going down here. So this gentleman told me he wanted to retire at 75. So at 75 years old, he'll retire. He'll have $4.8 million in the bank. Does he want to retire at 75, or does he think that's how long he needs to work to retire at 75? Once I showed him this, 55, hey, Misty Hutton, if you had $1.5 million in the bank, you think you retire with that? Liquid cash? Yeah. Especially, get this, people. Do you see this? 1512 to 1648. That's $136,000 of growth in 1 year. And we contributed $32,000. So that's $101,000 or $102,000 worth of growth. Misty, could you retire if you were making $102,000, whether you got out of bed or not, a year, if all your debt was gone and you had $1.5 million sitting in the bank? Of course you could. Okay. So this, of course, this gentleman's ecstatic. He's 36 years old. He's going to be able to retire at 55. So that's what this is about. This is about leveraging your dollars, making your dollars work for you, not against you. Making your dollars work for you, not you work for your dollars. Making the amortization schedule your friend, not your enemy. Okay. So what happens if you don't have a mortgage? Well, let's go to that one. Hold on one second. Almost there. Oops. There we go. So this is a college student I did one of these on about the same time. And she had a lot of debt for a college student. Why? Student loans. Student loans are evil, people. Okay. So $85,000 worth of debt, $91,000 of scheduled interest. Student loans are evil, people. And we got her out of debt in 9.7 years. Now look, these programs work for people. They're on sliding scales. How much you can afford to do, I don't know. The idea is that this should be a zero cost program for you. If you've got your money going into a 401k, why? Stop. Put it into this. Pay the tax on it now so you don't have to pay more tax on it later. If you're making $20 a month extra payment on your credit cards, why? Stop. Once you send that $20 in, it's gone forever. Put it into this program, then pull it out, and then pay the credit card off. So this girl, she's 24 years old now, 25. She's in a master's program at Cal Poly in marine science, doesn't matter. But she's got a lot of student loan debt, some basic others, car bill, car loan, stuff like that. She was going to be in debt for 40 years and have 100% equity in nothing, right? So we got her out of debt in 9.7 years. And when she is 55 years old, when I stop this, she's going to have $431,000 sitting in the bank. This is assuming that she never graduates from college. She never gets a job making more than she's making right now as a waitress. And the only thing she ever does is fund this thing at the rate of $350 a month until she's 55 years old. Anybody have an aha moment? Anybody know anybody like that? Nephew, niece, daughter, son? Yeah, me too. My daughter. So the point is that these programs work for people, for anybody. It doesn't matter what your debt load is, as long as you're making your debt service, it will work for you. It doesn't matter how much extra you have. We'll find the money. There's money somewhere. And I don't mean, again, tuna and ramen. That's not what I'm talking about. There's money somewhere that you're spending inefficiently. And so you should just get with whoever invited you to this and talk with them about it and do that exploration. Okay. So I want to stop for a second, open this up, and see if anybody's got any questions. All right. Well, there's a lot of people here today. All right. Brendan, you look relaxed. How are you, sir?
Listen, it's 80 degrees, so it is very relaxing on the back porch watching the boats go by and listening to you.
Oh, rub it in, sir. It was raining a few minutes ago, so thanks. All right.
We have a question over here, Scott.
Willa? Hey, Willa, go ahead.
Hey. Hold on, go ahead.
I just want to know, where is the money coming to pay off the debt? Is it your own money, or is this coming from the life insurance?
So you're taking a loan against the cash value of your life insurance program. And then you're depositing that money into your checking account and then paying whatever debt it is that you wanted to pay off.
Okay, and then also one other question.
How does it work if you don't have debt?
Then you have skipped the maximization phase and you are smack dab in the middle of the accumulation phase. And this is purely a growth vehicle designed for tax-free retirement. Or I've done those programs for other people that don't have any debt, but 3 years from now, 4 years from now, they'll have $20,000 or $40,000 in there, and they may want to go buy a home. So they'll take the $20,000 or $30,000 or $40,000 out and use that as a down payment for their home. It doesn't matter what you use the money for; it's your money. You just need to be prudent with the use of your money.
Hey, Scott, I have a question.
Yes, sir.
You mentioned with the one person that you did the plan for, they reached a point where all of a sudden it became almost a mech, and they had to pull the money out and put it into savings.
No. They never had to pull the money out. They just never put the money in.
Okay. All right. Well, I guess my question is for me, as we go, if I realize that our plan was too small and we could actually have put more money in, is that when can you amend the policy, or do you just write a new policy?
Contract. You got 30 days. Once the contract gets issued, you have 30 days to make changes. And then in some cases, you'll have up to 90 days to make a distribution change, but that's it. After you get beyond that 90 days, you're not making any changes to it at all. And all you're going to do at that point, if you need more room, rather than put the money into a savings account earning 2% at best, you put the money in another DFL program. You start it under the family member, anybody who's over 18 years old.
Okay.
And I do this with a lot of builders, and for the builders, they're like, all right, I got 3 nieces, I got 3 nephews, I got two children that are of age, and I got my wife. I want to do 8 of these because I'm going to do 8 flips this year. So they do one of these on a flip on every house they do.
Okay. Thank you.
Yep, Mr. Watson.
All right. So how do you begin? How do you determine what amount needs to go into the life and the term in the beginning so that you're able to pay the debt? That's why I'm a little confused.
Right. We work the numbers backwards. The first thing we do is we find how much money we can repurpose for this program. Okay. And then the second thing we do is we worry about how much money is going to go into term and whole life. And then we look at where your financial goals are and what's your retirement horizon? How much money do you want to be making when you're retired? How much of it do you want to be tax exempt? How much of it is going to be tax deferred because you're stuck in a 401k or whatever? There's a lot of math that you have to do this, but you're not going to determine how much term and whole life you have in the very beginning. That's a step 2 or step 3 process. The first thing you have to do is identify how much cash you have available for the program. Remember, it's designed and should be a zero cost program. We're not trying to create another bill. All we're trying to do is figure out where you're spending money, where you're overspending money, and we're going to repurpose that dollars. Remember, we're going to show you how to spend money more efficiently.
Okay.
Right.
So that's how you determine what the dollar amount that you have to go into this program?
Yep, that's how I do it.
Okay.
You know, it also depends what you're doing it for. Are you doing it for death benefit? Well, there's other programs out there where you can get more death benefit if that's what your goal is. But if your goal is retirement, debt elimination, income, that's what this program is for. Because this checks all three of those boxes. If your only desire is death benefit, this is not the program for that.
That's not my purpose, but thank you very much.
Okay. All right. Anybody else? You're all experts now, right? Right on. I don't see any questions in the chat. I got a few more minutes. All right, let's do an advanced product, an advanced concept. Hold on one second.
Yeah,
It's
I have a
that Jason
question.
Bridges has his
Oh, I'm
hand
sorry.
up.
Yeah, I was just wondering,
Jason,
when you sit down
unveil,
with,
sir. Let's see your beautiful face.
all right, might be a little dark.
There we go. Right on.
Yeah. So I was wondering, it's kind of sort of similar what Mr. Watson was asking, but how much do you recommend a person put in as far as what they're making part of their income and the bills that they're paying? Do you suggest that they hold some type of cash flow in, and
You know,
or
that's
hold it for
individual case by
themselves?
case discussion.
Yeah.
I'm, you know, if there is no debt and there is no extra money, like if you've got a 401k where they're paying you 3%, but you're funding it with 6%, that's a 3% overpayment. So I would repurpose that 3%. So there's lots of different places you can find money. Okay, but I can't tell you, you know, there is no hard fast rule. Use 10% of your income. There's no hard fast rule. It's a case by case basis, and it's what's the goal of the client. So you have to get down to that. It doesn't, and that's the other thing you have to think about as a broker underwriter for these. It has to make sense financially. It has to fit the guidelines for the amount of coverage, or you have to be able to explain why they need more coverage. So their age is a factor, because there's a certain amount of income we expect that you're going to have at a certain age. And then based on that age, there's also a certain multiple of how much coverage you should have and how much coverage you can have. And so there's other calculations in there. So you may say, yeah, Scott, I want to put $20,000 a month into this thing. And how old are you? I'm 65 years old. Not going to happen. Not easily. That's when you're going to have to get some exceptions and go to bat with the underwriter at the carrier and all this. So it can get really intricate. It's a good question, Jason. The problem is there is no hard, fast answer.
Yeah,
It's
case by case.
Individually.
Also, Matt, can I ask real quick if are you able to take out 100% of what you put in?
Nope. Well, maybe. Depends on when you take the money. If you put in $1,000 in year one and you don't touch it and it grows for 4 years, by the 5th year, you'll be able to take out $6,000. So can you take out 100% of what you put in? Sure. You're actually going to take out 600% of what you put in. So it depends on when you take the money.
Well, I'm talking about for the monthly bills. If you're paying off debt, someone's
Gotcha.
paying off debt and they have things to put in. If they put in 3,000, are they able to take the 3,000 right back out
Nope.
to pay off that debt, or
Nope.
how much is that?
Nope. You're able to touch 95% is what is withdrawable. And then depending on the carrier, they will do, most of the carriers are going to do an upfront 1 year interest payment. So if you put in $3,000 and you're just to make things easy, 5% is the interest payment, and you have access to 95%, then you can look at $3,000. The hard fast rule is 90%. So if you put in $3,000, you'll have immediate access to 90% of that. But this is a 30,000 foot view on that scenario. When you're using this and your dollar cycling on a monthly basis with your monthly bills, that's a different calculation that has to be done. And that's pretty intricate. So because you have to look at not only how much are you taking, but in what size increments are you taking? Which carrier are you with? And are you with a carrier that offers monthly compounding? Because if you are, then I take a $3,000 withdrawal, but my normal payment is $1,000 a month. If I do that, then it's going to take me 3 months to pay that $3,000 back if I'm letting him pay it back. But instead, if I switch it, instead of taking $3,000 in one shot, if I take three $1,000 loans, I still get $3,000 deposited in my checking account. But now each month I'm going to be paying back one of those loans. So that means my actual interest rate on my first $1,000 is only 1/12 of the annual interest. And then they will credit me back on a prorated basis the 11/12 that they took in advance that they didn't earn. And then in my second month, when I pay another $1,000, it's going to pay back that second $1,000 loan. And they're going to credit me back 10/12. And by third month, they're going to pay back that last $1,000. So I'm getting paid, I'm getting charged for 1 year of interest up front, but I'm getting the actual result is the net charge for me for that year is only about 1%. And that means I'm still earning 4% or 3% plus a dividend on that money. The only so this is where there's differences in the carriers. So I don't want to go too far afield here because this is just supposed to be an overview. But the differences in the carriers are going to determine not only how you can pay the loan back, how the loan gets paid back, but also if there's any interest crediting return, and how it's going to affect the dividend. So the carrier that does the monthly compounding, they will pay you a full dividend on any money that you got loaned out if it's paid back within a year. So if you borrow it on day one, pay it back on day 364, it's not going to affect your dividend at all. If you let it go to day 365, then that amount of money will not be subject to a dividend. So there's a lot of, it gets really deep. We can go really deep down this rabbit hole, but there's a lot of cool stuff, just depending where you want to go. All right. Anybody else before I show an advanced thing? All right, Zuma, here, let's hear Zuma.
Question. So you may have already answered this. So the upfront amount that we put in, that is based on the individual, how much they want to put in upfront into that account, or is it the same as whatever the monthly payment is going to be? So let's say the monthly payment.
Okay, so let's talk about what do you mean by upfront?
Okay, well, maybe I'm confused. So to start the program, imagine there's a premium, but can you put more money into it? So let's say the monthly premium is $300. Can someone say, well, I want to put in $5,000 into this account?
Okay.
Be able to loan from it, borrow from it later on.
Okay.
So is that how it works? Like the person can pick how much money they want to contribute into that account to start with?
When you structure the program, there's going to be a couple things that are going to be determined. Your target premium, your minimum premium, and then your max contribution before MEC. Okay. So the one I did last night, the max contribution before MEC was $52,000. The target premium was $7,000 annual. Okay. So that particular client is writing a check for $56,000 because of the target premiums, $4,000 is paying the term in the whole life. And then the delta is getting her maximally funded on day one. So she's stroking a check for $56,000. That's not unusual for people with large cash reserves. So I can't tell you which way to go. I can tell you that there is a ceiling that you can put in, and that's going to be determined by the term, the size of the term, and the size of the whole life.
Okay.
Okay. All right.
Thank you.
Anybody else? Okay. Hey,
Scott.
Chris.
Hey, how are you, sir?
Good.
I think Robert also has a question, but I have two real quick. You can only do this one time on a particular individual, correct?
Nope.
You can do it multiple times.
Yes.
Interesting. Second question would be, can a product like this or a program like this be used to preemptively fund something like, say, a college education for a young child?
Winner, winner. Yeah, all kinds of uses in these programs.
I'm feeling lucky.
There you go.
I got 3 kids.
Time, right? Right on. All right, you said Robert had a question. Who's Robert?
I believe Robert Leader. Looks like he has a hand up.
I don't see it. Okay. All right. So let's do this.
Very good.
Let's talk about mortgage chunking for a minute. And we'll see if we can get through this and maybe get to one more. So where's my mortgage chunking? Okay, so mortgage chunking is a technique that we use that's going to really, really anger your bank. And we don't care because our goal should be to tell the bank to go pound sand because they're not treating us fairly. So they can go to HE hockey sticks. So where we go here is this. So this is the family that I showed you earlier. Okay. This is the one that I used that we wrote back on Halloween a couple years ago. And none of this is different. We've got their mortgage. We know that they're going to be paying down their mortgage. Their mortgage original amount was $215,000 right there. Okay. So that's why we're using this as an example. So how does mortgage chunking work? So what mortgage chunking is we're going to make some assumptions. We're going to make an assumption that the family home for this illustration is $215,000 in a 30-year mortgage. Okay. We're going to make an assumption that we've got debts. Remember how we just showed you on that one particular family over about 2.3 years, we're getting to the point where that debt snowball has grown and it's become a juggernaut. And we're putting in $1,000 a month extra, and then we're getting to $1,500 a month extra, right? So in 2.3 years, this is the standard that I see for everybody. If you've got the magic number is 7, if you've got about 7 debts, that's about the time that the juggernaut, the mortgage, the debt snowball juggernaut becomes big enough that you can't stop it. As long as you continue to fund it the way that we're talking about, not spending any more money than you're already spending, as long as you continue with the program, you're going to reach that juggernaut level in 2.3 years. And what happens at that point? You get everything paid off with the exception of your mortgage, and you're generating $833 minimum of additional PUA purchase per month, which means once a year, you're going to be able to make a single $10,000 payment to your mortgage. Now, remember, this is a 30-year mortgage that we're using here as an example, $215,000. I don't know what that looks like for you locally, but for here, that this is a lower to middle end middle class home. You know, probably a 2,000 square foot brick ranch, 4 bedrooms, 2 baths. Okay, so how does it work? So when you look at your first mortgage premium and you look at an amortization schedule, this is the actual amortization schedule for this family, okay? So this mortgage payment schedule, they had $1,700 a month as payments. That's principal, interest, taxes, insurance, right? So their first payments were $851 in interest and $288 in principal. Can anybody show me anywhere on this where their interest rate of 3.2% is actually real? Doesn't exist, right? The interest rate on their first payment is actually 74.71%. There's the first lie. Okay, so when we're looking at this from a dollar use perspective, remember our goal is to make you or put you into a situation where you can spend money more efficiently. So here's the first lesson. So I'm going to go ahead over 2.3 years. May of 2020 is when I start. In 2.3 years, I will have paid off all my debts, and I will have enough money to make a single mortgage chunk payment, okay? So I'm gonna go ahead and advance 2.3 years. That's May of 2023. I've just through the normal process of paying my minimum mortgage payments, I've now paid my mortgage down to $203,000. And now my debt snowball is built. I've got $10,000 in my account. I'm gonna take a single $10,000 chunk. I'm gonna throw it at my mortgage, and it's gonna be 100% principal. All right, pay attention. This is cool. Right now, every payment I make is $332 of principal. I'm going to make a single $10,000 payment. Here comes your aha moment, Zuma. Boom. So I made my single payment. I'm now $193,000 of principal, right? But look at that. Now, every single mortgage payment I make from this point in the future is now $372 of principal or more. That's a 16% increase in efficiency of my regular mortgage payments. But more importantly, I eliminated $10,000 of principal. I have now advanced myself 2.5 years into my mortgage schedule. So if I had tried to continue making the payments with that $10,000, I would have made another, whatever this is, 10 payments, 10, 11 payments. In this scenario, I advanced myself through 27 payments. In this scenario, I just eliminated $23,000 of interest. Do you have an aha moment there? Come on, Jason, jump up and down, man. Pump your fist. Give me a reaction, man. There you go. So I just eliminated $23,000 of interest. I escalated my debt, my mortgage, and through an additional almost 3 years of mortgage premiums. I've advanced on the amortization schedule. My bank is angry at me. They don't want me to do it again, and I'm going to do it again as soon as I can. Okay. So this is what mortgage chunking will do. Traditionally, every mortgage chunk payment that you do, doesn't matter the size, but you're going to eat up realistically 2.5 times whatever that would have done as far as a payment is concerned. So if your payment's $1,000 a month and you make a $10,000 payment, you're actually paying not 10 payments, you're paying 25 or more payments at one time. You're eliminating that interest. You're making every single payment beyond that much more efficient. Everybody knows with an amortization schedule, you're not halfway paid off your mortgage until 20 years on a 30-year mortgage, right? We're going to get you there in 3 or 4 years. So in this scenario, the one I showed you, this is that same family, 7.8 years. Using a mortgage chunking technique, it's actually going to be about 5.6 years. Okay, so traditionally with mortgage chunking, if you incorporate it, and everybody can, if you incorporate it, it's going to make the program work anywhere from 11% to 26% more efficient. So if I demonstrate on the software 7.8 years, and I have a 26% increase in efficiency, that means I've got a 74% reduction, 74% time. It's 7.8 times 12. 93 times 0.74. That means I've gone from 93 months to getting out of debt to 69 months to getting out of debt. How about that one, Jason? Come on, man. Don't be shy.
It's a debt-free life.
Debt-free life, baby. Right on. All right. So that's mortgage chunking. I want to show you something else because I got I don't know, I got 7 minutes. Yeah, I really want to show this one to you. Okay, so this next piece is about everybody out there that has a mortgage. You make principal, interest, taxes, and insurance payments, PITI, right? Somebody give me a Anybody? There you go, right on.
That's
There
right.
we go. So that same house that I just showed you that we used in that last example, this is their actual mortgage, okay? They're paying $168 in taxes and $310 in insurance every month, right? That means they're paying $5,736 a year on taxes and insurance. So when you were 18 years old and you got your first job and they told you to claim 0 on your taxes because at the end of the year, they were going to give you a tax return, it's like a savings account, right? You're letting Uncle Sam keep the money for you. Uncle Sam is using the money. Uncle Sam is investing the money. Uncle Sam is making money with your money, and Uncle Sam is not sharing, right? This is the same thing. You have a mortgage company and they are happy to take your taxes and your insurance escrow payments and hold it for you because they're investing it and they're making money with it. And then they're making it so you don't have to write a check. That's what this is all about. So you don't have to write a check to your local county for your taxes or to your homeowner's insurance company. Why? Okay, $5,736 a year. Remember, the whole concept about debt-free life is being able to put money someplace, sequester it, keep it forever, pull it out when you need it, and use it when you need it, right? but you're not pulling the principal out, you're pulling out a loan. So if I put $5,736 into my DFL program for 1 year, because that's my taxes, my escrow payment, and I pull it out when I need it, and I pay my taxes, my escrow payment, I'm going to earn, at worst case, $229. That's my 4% interest. That's before the dividend. And it's going to cost me a little bit more than that to do this program in the first year. I'm going to lose $45, but here you go, Jason. Here's the magic. It's not magic, it's just math. $45 is my cost for the first year. If I do it the second year, now the amount of money I have in my program, because remember, I'm depositing $57.36 per year into my program. The second year, I now have $11,893. That's the guaranteed 4% return, plus my 2 years of $57.36 contribution. And I now pull out the money to make my taxes and my escrow payment. And what happened at that point, the combined 2 years of return, it is now generating an additional income revenue every year. But more importantly, what happens? The magic right down here. It's actually year 16 for this particular family. In year 16, the guaranteed interest, not the dividend, not including the dividend, just the guaranteed interest generates $4,495 a year. Guaranteed interest, guaranteed interest, guaranteed interest, right? That's going to be enough in year 16 to actually pay this $57.36 that I need. More importantly, boom. At the end of that run in 15 years, I have sequestered $119,000 of additional money in my DFL bank. Whose money is that, Zulma? It's my money. Yep. Can the IRS tax me on it? Nope. Can the IRS penalize me if I want to pull it out? Nope. Can the IRS penalize me if I wait till after age 72 to touch it? Nope. Can the IRS tell me that you're not 59 and a half, you can't touch it yet? Nope.
Nope.
It's my money. I do whatever I want to do with it, whenever I want to do something with it. But here, if you're smart about it, you'll never ever touch it. So remember, in the very beginning of this conversation, we talked about creating generational wealth, okay? This is a new concept because this wasn't around back in the Rockefeller Rothschild days. This is something that we came up with, okay? This is an idea of why am I paying my taxes and escrow payment to a company that's not giving me a dime? They're happy to take my money. They're happy to make money with my money, but they're not doing anything for me other than writing a check. I'll write the check. I'll be happy to write the check. Give me $120,000 in 15 years. I'll write 15 years worth of checks for $120,000. Is that worth it, Jason? Is that,
Yeah,
you think
that's really worth
getting
it.
paid $119,000 is worth writing 30 checks? Yeah.
Yeah.
I mean, you could be absurd with this, and we can say, okay, how long does it take you to write a check? About 2 minutes. Costs you about 50 cents to mail it. So what's your cost to do that? Okay, so over the course of the next 15 years, it's going to cost me $100 to make 119,000. Did you have a holy cow moment?
Hey, Scott,
Yes, sir.
I know we're running out of time,
Hi.
but there was one question I had based on the pre-funding of a student education, a college education, using this. So normally people use 529 plans, right, in order to save for college these days.
Sure.
Right. When let's say I build up a huge 529 plan, $100,000 by the time my kids gets ready to go to school. When I go to apply for any financial aid, are they going to give me any?
Well, this is life insurance. This is not going to show up and it's not going to inhibit your ability to get that student loan.
So rather than doing a 529 plan, if I set up a DFL as a college savings vehicle, when I go to apply for financial aid, they're not going to see any of that money, and I can get financial aid.
It's life insurance, baby.
Okay, but if I did 529, I wouldn't.
Yeah, if you did a 529, they're going to say, okay, you got a 529, great. How much is in there? Okay, great. We will give you the delta as loan capacity for your student loan. Student loans are evil, people.
Yep. So the more prepared you are using a 529 plan, the less benefit you get.
Yeah.
Okay, just making sure. Okay. No, I
Yeah.
thought that was I thought that was an important point, is that this money's kind of invisible from things like that.
It is.
So it's got a cloak on it. This is not your money.
This is not your money.
These are
This
not
is the
your
money you're
money.
looking for.
I'm having an issue with a 529 right now and a daughter that doesn't want to go to school, and I can't do anything with money without being heavily taxed and penalized.
Sure you can. Sure you can. Go buy lots of books and what else can you eat in the student cafeteria a lot?
I can go take a pottery class.
There we go. You could
Donna,
probably teach the pottery class, Donna.
I was gonna say the same thing, that this gives you more flexibility, that if a kid doesn't want to go to school, that's a savings account for them to start their life, whether it's a business, coming into our business, or do whatever they want to do. It's not nothing limiting it.
Right on. Absolutely.
Was on the phone with a candidate today, and she was telling me about her son who's going to be playing baseball for a Division II NCAA school, because that's the only way they can afford for him to go. And the third child, she's thinking may not be wanting to go to college anyway. May want to go right into the workforce.
Right on.
Yeah. So
all right, any other questions before we close this out?
Thank you.
Question in the chat. Oh, gotta go.
Thank you, Scott.
All right, guys.
Appreciate you.
So the only thing I would say to you at this point is if you're an agent looking to do DFL programs, you're going to have to get trained on the new DFL software that's coming from Symmetry. If you are a potential client looking at these programs, get with whoever invited you and get started. These programs take a long time to put in place, and you're going to have plenty of time to make some decisions and changes. Just get rolling with it. All right. Goodbye, everybody. Have a great night.
Bye, everybody. Take care.